All right, so welcome to another deep dive, and today, today we're going to try to understand what's going on in the cryptocurrency market, specifically these declines. Right, it's something that I know a lot of you are really interested in, and we're going to get right into it. We've got research, we've got news articles, we've even got some market analysis reports, and all to give you that kind of clear and concise understanding that you're looking for. And joining me is, well, I guess you could call him a cryptocurrency market whisperer.
Yeah.
They're going to help us kind of connect the dots and see not just what's happening, but like why it matters.
Yeah.
So let's just start with kind of like the current situation, right? Bitcoin, it just took a 10% hit just this week, a single week. And a lot of those altcoins, they're seeing even bigger drops. It's like a total roller coaster out there. What is going on? What's at the root of all these declines?
Well, it's actually a really fascinating mix of factors. We've got, we've got global events kind of shaking things up. We've got the economy throwing some curveballs, and then of course we've got those inherent kind of weaknesses within the crypto world itself. Oh, and we can't forget about meme coins. They're playing a role in all of this too.
Meme coins.
Yeah.
Seriously.
Oh yeah.
Okay. You got me intrigued. But first, you mentioned global events, and the research points to former President Trump's trade policies actually having this really kind of surprising connection to how the cryptocurrency market moves.
Yeah. It might seem a little odd at first glance, but there is a 28% correlation between, Trump's trade policy announcements and how the crypto market reacts. Remember back in February of 2025 when he made those threats about tariffs on EU imports? Well, institutional investors, they pulled out something like $74 billion out of crypto ETFs. They saw the potential for some instability on the horizon, right? So they just moved their assets to what they considered safer ground.
So it wasn't just like political noise. There was an actual economic ripple effect.
Oh, yeah, absolutely. The data shows a very, very strong correlation between Trump's rhetoric and Bitcoin's price, especially over a 30-day period. We're talking an R squared of 0.84. It really underscores how integrated crypto is becoming with traditional financial markets. When the global scene gets a little rocky, crypto, it definitely feels the tremors,
Yeah. But what's interesting to me is why, why did those investors react that way?
Well, think about it this way. Institutional investors, they're always looking at the big picture, right? And Trump's trade policies, they signaled this potential disruption to global trade flows. And that could, potentially impact the US dollar stability. It could even trigger a recession, So for those investors who are holding crypto, it made sense to reduce their exposure and move to assets that are seen as less risky during times of economic uncertainty.
That makes a lot of sense. It's kind of like battening down the hatches when you see a storm brewing.
Exactly.
But what about the Federal Reserve? How do their actions kind of tie into this crypto roller coaster?
Well, the Fed's actions, they're absolutely critical here. Their delayed rate cuts and the fact that we're still dealing with 5.4% inflation. I mean, that's injected a whole lot of uncertainty into the markets. And, historically, crypto's always been much more sensitive to interest rate changes than traditional stocks.
So a hesitant Fed equals a shaky crypto market. Is there a way to measure that sensitivity?
There is, yeah. It's called beta. And it measures, how much an asset's price moves in relation to the overall market. Now, for crypto markets, that beta is 2.3 when it comes to interest rate sensitivity. To put it simply, if interest rates go up by 1%, a typical stock, it might dip by, let's say, 1%. But crypto, with its higher beta, could drop by over 2%.
Oh, wow.
And that's exactly what we're seeing. Hedge funds, for example, they've slashed their crypto exposure by 22%, and that's just in the first quarter of 2025. It's classic risk aversion. They're mirroring those same moves that are happening in the wider financial world.
Right. So we've got the global politics. We've got a cautious Fed, but the research also points to some internal weaknesses within the crypto world itself. What exactly are we talking about here?
Well, we're talking about centralized exchanges.
Yeah.
CEXs, they're a major vulnerability. They handle the vast majority of crypto trading, but statistically, they're much more likely to fail compared to their decentralized counterparts.
How much more likely are we talking?
Oh, a pretty shocking 31.2% more likely. And a perfect example of this is the Bybit hack
Yeah.
from February.
Oh, yeah. What happened there again? Remind me.
Well, Bybit, it's one of the major centralized exchanges, right? And they had this security flaw that got exploited, and poof, like $1.5 billion worth of Ethereum, it just disappeared.
Oh, wow.
That hack really sent shockwaves through the crypto community, and it highlighted those inherent risks of these centralized systems.
So why are these CEXs so susceptible to these problems?
Well, think of it this way. A centralized exchange is like a fortress,
Yeah.
but it's got one massive gate. And if that gate is breached, well, the entire system is compromised, right? That's why they're so vulnerable to these single point security failures. They also can face liquidity mismatches, which can trigger a collapse. And then there's this thing called regulatory arbitrage, where they exploit loopholes and inconsistencies in regulations.
Okay, so I'm starting to see the appeal of decentralization now.
Mm-hmm.
But before we go too deep down that rabbit hole, let's talk about those meme coins that you mentioned earlier. I'm really curious about how they're adding to market volatility.
Oh, it's almost paradoxical, right? Meme coins, like Dogecoin or Shiba Inu, they represent a tiny fraction of the total crypto market, less than 0.3% to be exact.
Wow.
But they've got this really strange power to sway Bitcoin's price, and it seems completely out of proportion to their size.
Yeah. They seem like such a small corner of the market. How can they have that much influence?
Well, algorithmic trading systems, they've gotten incredibly sophisticated. They've picked up on this correlation between meme coin activity and Bitcoin's volatility. Right now, they're attributing about 18% of Bitcoin's recent price swings to what's happening in the meme coin world.
Wait, hold on. Are you saying that these meme coins are like the butterfly flapping its wings and causing a hurricane across the globe?
That's a great way to put it. It really shows how interconnected the crypto market is, even when it doesn't seem logical on the surface. And it's not just about price fluctuations either. Meme coins, they're attracting the attention of regulators, and that's just adding another layer of uncertainty.
So what kind of regulatory concerns are we talking about here?
Well, there was the Memecoin scandal in Argentina. That was a meme coin that was actually tied to a political figure. And it really raised concerns about the potential for market manipulation and investor protection. And now we've got like 34 countries that are considering restrictions on meme coins. It's a minefield out there.
Wow. So we've got global events, we've got economic uncertainty, we've got these internal vulnerabilities within the crypto world, and now we've got meme coins just kind of stirring the pot. No wonder the crypto market is feeling a little queasy.
Yeah.
But is this just a temporary blip, or are we looking at something more serious?
Well, to answer that, we really need to kind of take a step back and examine some historical precedents. You see, crypto crashes, they aren't new, and they tend to follow these patterns that can give us some insight into what might come next.
Okay, let's take that trip down memory lane. I'm all ears, or should I say I'm all algorithms?
Right. Let's go all the way back to the early days of Bitcoin and the infamous Mt. Gox exchange hack of 2011.
Man, Gox. Oh yeah.
Yeah. No, for anyone who's new to crypto, a centralized exchange is basically a platform where you buy and sell cryptocurrencies. Back then, Mt. Gox was the major exchange.
Yeah. That name definitely rings a bell. And it wasn't good.
It was a disaster. That hack caused Bitcoin's price to plummet, like a mind-blowing 99.9%.
Oh wow.
It went from $32 to just a penny.
Oh my God.
It was a brutal reality check for the entire crypto community, and it really set the stage for future crashes.
So what can we learn from Mt. Gox and those other crashes from crypto's past? Are there any recurring themes that kind of stand out?
Absolutely. What we see is a pattern. Exchange failures, they often trigger liquidity crises. Then you've got regulatory actions that lead to these massive sell-offs. And then because of limitations in the technology back then, recovery times, it just took so much longer. But one key takeaway from Mt. Gox, and really for understanding the current market, is the vulnerability of centralized exchanges.
Yeah. It makes you wonder if decentralization is the key. But that's a conversation for another time. Let's stick with those historical patterns for now.
Okay, so let's fast forward a bit to 2013. Remember how I mentioned those liquidity crises?
Uh,
Well, when Mt. Gox, yeah, but again, had some technical issues and had to, halt withdrawals, Bitcoin's price, it tanked, fell like 83%. And then that same year, China decides to ban banks from handling Bitcoin transactions, and boom, another 50% drop. It just shows how susceptible that early crypto market was to these internal hiccups and those external pressures that we talked about earlier.
It really seems like regulation or the lack of it, played a huge role in those early crashes.
It did. Absolutely. When regulations are unclear, it just breeds fear and uncertainty.
mhm.
And that's especially true for those big institutional investors. When they start pulling out, it can create this domino effect, right? And
Mhm.
that sends the whole market tumbling. But lack of regulation, it isn't the only thing that spooked investors. The technology itself, it's played a role too.
Okay, so Matt Gox taught us about exchange vulnerability and China's ban. Well, that showed us those regulatory risks. Any other major crashes that kind of shaped the landscape?
Oh, definitely. Think back to 2022 and that whole Terra Luna collapse. That one really shook the DeFi space, showing how interconnected protocols combined with shaky tokenomics and a good dose of panic, can really amplify market declines.
Yeah, that one was rough. I remember hearing it just wiped out like billions.
It did. It did. When Terra's algorithm stablecoin UST lost its peg to the US dollar, it set off this chain reaction that basically decimated the entire
Yeah.
ecosystem. We're talking $45 billion in market value just gone, vanished. And LNAA supply, well, it inflated by something like 6,000 to 500 times.
Whoa, that's hard to even wrap your head around. What were the main takeaways from that crash?
I think for me, it boiled down to this. It
Yeah.
really exposed the risks tied to those complex DeFi protocols and proved how quickly things can just fall apart when trust erodes. It also showed just how important it is to have, sound tokenomics. A poorly designed token, it can create a death spiral. And we can't forget about the human element, the retail investors. They're panic selling, which often comes from a lack of understanding about the technology. I mean, it just throws gasoline on the fire.
So we see these patterns of booms and busts, right? Driven by failing exchanges, regulatory crackdowns, and these weaknesses in the crypto system itself. I mean, does this mean we're making the same mistakes?
That's a great question. And while each crash has its own, unique set of circumstances, there are definitely some parallels. Look at the recent Bybit hack, for example. I mean, it's a stark reminder that centralized exchanges they're still a weak link. And the regulatory uncertainty that we're seeing now, well, that just echoes those challenges from the past. And let's not forget about the Memecoin craze. It feels a lot like a classic case of speculative excess to me.
So it seems like history is rhyming, even if it's not repeating it exactly. What do you think are the biggest obstacles to achieving a stable market this time around?
Well, we're seeing some regulatory coordination failures for one.
Yeah.
Everyone's talking about the need for clear guidelines, but the U.S. Congress still hasn't passed, crucial legislation like the FIT 21 Act. It means we're still kind of operating in this Wild West environment. There are no clear rules on exchange reserves, stablecoin oversight, or safeguards against market manipulation. It's like trying to build a house after a hurricane without a blueprint. Or
Yeah.
building codes.
Right. So
Yeah.
so what's the impact of all this regulatory limbo?
Well, it means recovery takes longer. It's chaotic. It's inefficient, and it sets us up for more setbacks down the road.
Okay. So regulation is one piece of the puzzle,
Yeah.
but are there other challenges that are kind of standing in the way of recovery?
Well, we've got to address the technical limitations of blockchain technology itself. Bitcoin's transaction throughput, it's still pretty low, and when activity spikes, the network gets jammed. It causes delays. It pushes up fees. It just frustrates users, right?
Yeah.
And all of these things can make market declines even worse.
So we're not just fixing the rules of the game. We need to upgrade the field itself.
That's exactly right. Blockchain technology is still evolving. Developers are working on improving scalability and efficiency. But until we have a more robust infrastructure, these bottlenecks are going to persist, and that's going to amplify volatility.
We've painted a pretty sobering picture here, but I want to end on a hopeful note. Are there any strategies or solutions out there that offer some hope for a more stable and resilient crypto market in the future?
There absolutely are, and some are already in play. For instance, institutional investors are increasingly turning to these sophisticated risk management tools to navigate this crypto roller coaster. Things like Bollinger Bands and average true range indicators are helping them make better decisions about position sizing and managing their risk tolerance.
So bringing the wisdom of traditional finance into the crypto world.
Exactly, exactly. But while it's great to see those big players stepping up, it's just as crucial for everyday investors, like you, to learn about risk management too.
Right.
Avoid those emotional trading decisions. Knowledge is power, especially in this space.
I like that. Knowledge is power. But zooming out a bit, are there any larger systemic changes that could make a real difference?
Well, it all circles back to regulation. The
Mhm.
EU's MiCA framework and that proposed FIT21 Act in the U.S., though it's been delayed, they offer a lot of promise. They're designed to reduce systemic risk through things like mandatory reserve audits, segregated customer asset requirements, and standardized stress testing protocols. Imagine guardrails to help prevent another Bybit style
Mhm.
meltdown.
Yeah, yeah. Sounds promising. But when can we realistically expect these regulations to be, in place and working?
It's a long game, unfortunately. We're looking at timelines that are extending to 2027. That means we'll likely see, continued volatility in the near term.
Yeah.
However, long term, these regulatory frameworks, they have the potential to seriously dampen the impact of future crashes.
So there's light at the end of the tunnel, but we're not there yet. For our listeners who are trying to make sense of this complex and often confusing crypto landscape, what's the most important thing to remember?
Well, crypto markets are cyclical.
Mhm.
We've seen the booms and busts throughout history, and this downturn is just part of that cycle. The key is to stay informed, manage your risk and avoid making impulsive decisions based on fear or hype.
So stay calm and carry on. Sounds right.
Exactly. You're not abandoning ship, you're learning to navigate the storms.
I love that analogy. As we wrap up this deep dive, I'm curious about your big picture perspective, given
Right.
everything we've talked about. Where do you see crypto going in the long run? Is it destined to remain volatile and niche, or can it truly transform the financial system?
That's the billion-dollar question, isn't it? I truly believe that crypto has the potential to revolutionize finance, but the road ahead, it's going to be long and it's going to be bumpy. We're still very much in the experimental phase.
So it's like the Wild West of finance,
Yeah.
full of pioneers and outlaws and the promise of gold, but also fraught with danger and uncertainty.
A perfect analogy. And just as the Wild West eventually became, more settled and structured, I believe crypto will too, but it's going to take a collective effort.
A call to action for all the crypto cowboys and cowgirls out there. What do we need to do to make this happen?
We need to build a more robust and reliable infrastructure, for sure.
Mhm.
We need clear and consistent regulations, and we need to educate the public about both the incredible opportunities and the very real risks of this new financial frontier.
Yeah, that's a great point. It's not just about the technology or the regulations. It's about empowering people,
Right.
giving them the knowledge to make informed decisions.
Absolutely. Informed investors are the foundation of a healthy and sustainable crypto ecosystem.
Well said. This has been an incredibly insightful deep dive. Thank you so much for joining us and sharing your expertise.
Oh, it's been my pleasure. Always happy to demystify the crypto world.
And all of you listening, thanks for diving in with us. We've covered a lot of ground, from the cyclical nature of crypto markets and the factors that are driving those recent declines to those potential solutions for building a more stable future. But as you continue to explore this fascinating world of cryptocurrency, here's a final thought to consider. We've seen those historical patterns, a boom and bust, and we're still grappling with regulatory uncertainty. What does that tell us about the long-term viability of crypto? Will it remain this, volatile niche market, or can it truly evolve into a more stable and inclusive financial system? Keep those questions in mind as you navigate the exciting world of crypto. Thanks for tuning in.